to Iron Financial. This is the only place where we forge stronger portfolios by cutting right through the market weakness. And today, we are putting a giant on the anvil. AT&T. The telecom titan just dropped its Q4 and full year 2025 numbers, and you can feel the tension in the market. Everyone is trying to figure out if this company is building an impenetrable fortress of cash flow or if it's just a gilded cage buckling under the weight of its own debt. We're going to break down the filings, dissect the conference call, and give you the unvarnished truth you need. All right, let's get into it.
Right. And that's really the billion-dollar question, isn't it? I mean, for decades, AT&T has been this absolute staple for income investors. People call it a dividend king, and for good reason. But here's the thing. A king can still have a crumbling castle. We all see the big, juicy dividend. We all know the household name. But what is really lurking beneath the surface? Is the foundation of this company solid rock? Or is it just sand waiting for the tide to come in and wash it all away? That's what we're here to find out. We are going to stress test this entire structure and see if it holds up under pressure.
Exactly. So, first up, let's build the bull case. Before we go looking for cracks in the armor, let's examine the steel frame that's holding this thing up. The argument from AT&T and from the bulls is actually pretty simple. They are a connectivity juggernaut, a behemoth that is methodically executing its plan. So let's look at the hard numbers, the cold, hard facts that form the bedrock of this entire argument.
Okay, let's start at the top line. For the fourth quarter of 2025, revenues clocked in at a massive $33.5 billion. Now, it's easy to see a number that big and just let it wash over you, but what's really crucial here is the context. This isn't just a big, static number. It represents a 3.6% year-over-year increase. Now, you might think, 3.6%, is that a lot? Well, in a mature, cutthroat industry like telecom, that kind of growth is a clear signal of real strength. It tells you they're not just treading water. They are actively taking market share from their rivals and expanding their reach. This is the engine of the entire operation, and right now, all signs point to it firing on all cylinders. Next up, we have to talk about the lifeblood of any company, but especially one with the kind of commitments AT&T has. I'm talking about free cash flow. In the fourth quarter alone, they generated $4.2 billion. And just like with revenue, that's up 4.2% from the exact same quarter last year. And let's be crystal clear. This isn't some fuzzy accounting entry. This is actual spendable cash hitting their bank accounts. This is the money they use to pay that famous dividend, to reinvest in their 5G and fiber networks, and most importantly, to pay down that mountain of debt we're going to talk about. A strong and, more importantly, growing free cash flow is absolutely non-negotiable for the bull case. And this number delivers.
So the natural question is, where is all that revenue and cash flow growth coming from? Well, you don't have to look any further than their core mobility business. For the fifth consecutive year, AT&T added over 1.5 million postpaid phone subscribers. These aren't the low-margin prepaid customers. These are the high-value, monthly contract customers that form the absolute backbone of their wireless division. This is not a one-off success story or a flash in the pan. This is a sustained trend of winning in the market. It shows their network is competitive, their marketing is hitting the mark, and they are consistently dominating in the most important segment of the entire wireless market. This is a sign of a very, very healthy core.
Okay, so let's pull back from the single quarter and look at the full year picture for 2025, because this is where the story gets really compelling. This table right here lays out the entire bull thesis in black and white. You can see the numbers are climbing, and climbing impressively across the board. Full year revenues hit $125.6 billion, up 2.7%. Now look at the next line. Adjusted EBITDA grew even faster, up 3.6% to $46.4 billion. That tells you they're not just growing sales, they're growing them more profitably, which is key. But the absolute star of the show, the number you have to focus on, is at the bottom. Full-year free cash flow of $16.6 billion. That's an 8.1% jump from 2024. These are not just small, incremental gains. This is a powerful, consistent operational engine that is gaining momentum. This is the financial fortress the bulls are pointing to.
Okay, the numbers look solid, I'll grant you that. But hold on a second here. We have to ask, is this just a case of a rising tide lifting all boats? I mean, is the whole telecom industry just having a good run? Or is AT&T doing something specific, something unique and durable that gives them a real, lasting edge? Because if this is just a cyclical upswing, that means the whole structure could be a lot weaker than it looks on the surface. We need to understand the how behind these numbers. What is the actual strategy that's driving this?
That is the perfect question. In this slide, this single number has the answer. The how is a strategy they call convergence. And this number, 42%, is the proof in the pudding. What this means is that a staggering 42% of households that have AT&T Fiber for their home internet also choose AT&T for their wireless service. This is the brilliant core of their entire strategy. It's not just about selling a phone plan or an internet plan. It's about owning the entire connectivity relationship with the customer. When you bundle those services, customers become incredibly sticky. They're far less likely to churn and switch to a competitor, and their total lifetime value to the company absolutely skyrockets. This isn't some broad macro trend. This is a specific, deliberate, and highly effective business strategy playing out in real time.
And that powerful convergence strategy is built on the back of their absolute dominance in fiber. Look at this first point. For the 8th consecutive year, they added over 1 million AT&T Fiber net subscribers. Just think about that level of consistency. This isn't a fad. It's a long-term, multi-billion-dollar investment that is paying off big time. Their consumer wireline division, which houses the fiber business, saw revenues jump 2.9% in the quarter. But even more impressively, look at the profitability. The EBITDA margin expanded from an already healthy 35.2% all the way up to 38.4%. They're not just selling more service, they're making much more profit on every single sale. And they are not stopping. They're doubling down, acquiring fiber assets from Lumen and wireless spectrum from EchoStar to push their reach even further. They are building a competitive moat, and it is getting wider and deeper every single quarter.
A moat is great. A strong engine is fantastic. But every skyscraper, no matter how tall and shiny, has to have a foundation that can support its own weight. You've built a very, very compelling case for the operational strength of this company. The engine is humming. But what about the chassis? What is this entire massive enterprise actually built on? We've spent all this time talking about the assets, but now we have to talk about the liabilities. What's holding this whole structure up?
And that brings us to the other side of the ledger. It's time for the bear case. If the bull case is all about that powerful cash flow engine, then the bear case is about the massive, crushing weight that the engine is being forced to carry. And we are talking, of course, about the debt. Let's not mince words. Let's put a number on it. There it is, $117.4 billion, with a B, in net debt. Just let that number sink in for a moment. This is one of the largest corporate debt loads on planet Earth. It is a staggering figure that casts a very long shadow over everything else we've just discussed. It doesn't matter how strong your cash flow is. A debt pile of this magnitude creates immense, constant pressure. It limits your flexibility, it introduces significant risk, and it demands to be serviced, day in and day out. This is the anchor that weighs on every single strategic decision this company makes. Okay, $117 billion is a massive, almost incomprehensible number, but context here is key. The bulls will immediately point you to the left side of the slide. They'll say, look, we know it's big, but we are managing it responsibly. The crucial metric they'll point to is the net debt to adjusted EBITDA ratio. And you can see that ratio has improved. It's down from 2.68 times a year ago to 2.53 times now. They're using that strong free cash flow to methodically chip away at the mountain. Their target of 2.5 times is right there within sight, but that's where I have to step in. Because that entire narrative of steady deleveraging, which is laid out on the right, just got a massive plot twist. AT&T is out there buying assets from Lumen and EchoStar. And what happens when you buy billions of dollars of assets? You take on more debt. Management has been crystal clear. After these deals close, that leverage ratio is going to jump right back up to around 3.2 times. So that 2.5 times target they were so close to hitting, yeah, it's now by their own admission roughly 3 years away. They are taking one step forward, but they're about to take 2 giant steps back. The finish line just got moved. And if you want to know where that margin for error went, look no further than this direct quote from the earnings call. While they're talking about a new 3-year journey just to get their debt back under control, they are in the very same breath promising to return over $45 billion to shareholders in that exact same 3-year period. $45 billion. That's through their dividend and their share buybacks. This is not some small, casual commitment. This sets up a direct and frankly unavoidable conflict of priorities. You simply cannot claim to be aggressively paying down a mountain while simultaneously promising to give away the shovel.
Exactly. How on earth does that math make any sense? Let's break it down. 1. They are starting from a higher debt base because of the new acquisitions. 2. They now have a multi-year path just to get back to where they almost were. And 3. At the exact same time, they are promising to give away more than 75% of their projected free cash flow to shareholders. How do you aggressively pay down a mountain of debt when you're giving away 3/4 of your heavy machinery?
It feels like trying to bail out a sinking boat with a thimble while simultaneously promising to pour most of the water you collect right back into the boat. The numbers are pulling in completely opposite directions, and it just doesn't add up.
Look, the plan isn't just tight, it's a financial high-wire act with no safety net. This bar chart lays it out perfectly. The company projects generating around $59 billion in free cash flow over the next 3 years. That's the first bar. Of that, they've publicly committed to returning over $45 billion to shareholders. That's the second enormous bar. So what does that leave for everything else? That tiny little sliver at the end is what's left for actual meaningful debt reduction, for reinvestment, or for any unexpected economic downturns or competitive threats. For a company of this size and complexity, that is a razor-thin margin for error. The math only works in a perfect best-case scenario with absolutely zero surprises, and we all know how often that happens in the real world.
And that best-case scenario is so far from a guarantee because there are other potential fault lines running through this foundation, beyond just the debt. While their consumer wireline business is booming thanks to fiber, their business wireline segment is in a state of managed but persistent decline. It's acting as a constant drag on overall growth. They're also burdened by extremely high operating costs from their legacy copper network, and shutting that down is a slow, complex, and very expensive process. Then you have the integration risk. They're spending billions on these new Lumen and EchoStar assets. Making those purchases actually pay off and generate the returns they've promised is a massive operational challenge, and it is absolutely not a given that they will succeed. It all comes back to one single point of failure. This entire complex strategy depends on flawless, perfect execution. There is no plan B. There is no room for error.
So here we are. We have two powerful, competing narratives. On one hand, the bull case, a powerful, growing connectivity business that is generating massive, impressive amounts of cash. And on the other hand, the bear case, a company weighed down by a mountain of debt and locked into a capital return plan that leaves absolutely no room for error. So it's time to bring these two arguments together, put them on the scales, and forge a final verdict for you, the Iron Financial audience. Is this structure sound, or is it at risk of a catastrophic collapse? All right, let's lay out the final blueprint, side by side. On the structural strength side, you have the undeniable power of their free cash flow generation. $16.6 billion in 2025 is a formidable figure that solves a lot of problems. You have consistent, impressive subscriber growth in their most important businesses, mobility and fiber. And their convergence strategy is clearly working, creating a stickier, more valuable customer base. These are the solid steel beams of the bull case. But on the other side, you have these very real potential fault lines. The debt is massive, and it's about to get bigger before it gets smaller. The capital return plan is so aggressive that it severely limits their financial flexibility. And the entire bullish outlook, the entire path forward, depends on future growth materializing exactly as planned to manage all these competing financial commitments. These are the stress fractures that could, under the right pressure, shatter the entire structure.
So here's the bottom line. Here's what it all comes down to. AT&T is a cash flow machine bolted to a mountain of debt. There is absolutely no debate about the strength of the engine. The numbers we've shown you prove it's powerful and it's running well. The real question, the one every single investor has to answer for themselves, is not if the engine is strong, but if it's strong enough to actually move the mountain. Can it generate enough power consistently, year after year, to not only carry its own immense weight, but also shrink the massive burden it's attached to, all while funneling billions and billions of dollars to shareholders? That is the core tension of this entire investment. How you answer that single question will determine whether you see AT&T as a solid foundation for your portfolio or a structure that's already under far too much weight. That's our analysis from Iron Financial. Do your own diligence and decide if this is a structure you want to own. Stay sharp.